Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we are taking a look at risk in the markets and strategies to protect portfolios. To do that, I speak with Keys Tinney and David Verratti of Blue Sky Asset Management and QuantX funds. The fund lineup includes several risk-managed funds, and we discuss the key things to know about this approach and why they believe this is a solid strategy for investors. So if you have any questions or comments, make sure to send them in to podcast@zacks.com. And don't forget to find the Dutram Report on iTunes and give us a review there as well. But stay tuned for my chat with Keys and David right after this. Okay, guys, thanks for joining me today. Let's start with you, Keys. Maybe you could tell us why it is so important for investors to manage their risk exposure.
Yeah, I think for a number of reasons. Primarily what we hear from the advisors we work with is that as we get further away from the last kind of bear market in '08, we're getting closer to another one. And that's scaring them and scaring their clients, right? Because at some point, something's going to cause the market to correct. And what we hear is that they're looking for tools above and beyond prototypical modern portfolio theory and diversification. Like, what else can we do to protect clients? And the reason why is because a lot of the clients and the investors are nearing retirement or whatever that goal may be, or in retirement. And they can't afford to have the big drops in their portfolios that we've seen in '01, '02, and in 2008. Because if you're before retirement and you lose a third of your portfolio, you're gonna have to work longer, right? And if you're in retirement, you may have to go back to work, and no one likes those options.
Absolutely.
And so we think it's mission critical to have those important conversations with those investors to make sure that they understand kind of the components of the portfolio and what's possible if something was to happen in the markets, and then having honest conversations with them about the various ways to put solutions in play that protect them.
Yeah, and you know what? It seems to me that with the markets continually hitting new highs as of late, and as you said, we get further away from that last bear market, people are starting to forget about this crucial aspect of investing. How do you keep this on the forefront of investors' minds, considering how well things have gone over the last 6 months at least?
I couldn't agree more. I mean, the further you get away from whatever that anchoring event was, i.e. 2008, you have a long bull market, people start to forget about it. Certainly fresh in their mind in '09, fresh in their mind in '03, or when the advisors are saying, hey, maybe we should take more risk exposure, and they're saying, wait a minute, I just lost a third or more of my portfolio. Are you kidding, right? And that's the behavioral aspects of it, right? And so diversification is the constant disappointment, right, where you're constantly trying to diversify because these risks exist, yet the clients are saying, hey, the S&P's this, and this asset class is up so much. They forget about it. They really do. And so that's why we're grounded in the risk management aspect of it, because we want exposure when the time is right to have that exposure, when the waters aren't choppy, right? And when the waters get choppy, we want to have systematic ways of taking chips off the table. But I totally agree with you.
Yeah, and David, maybe you can jump in here. I was kind of wondering how you guys look to manage risk and what sort of metrics you look at in order to keep things stable. And maybe you can talk a little bit about the macro risk indicator you guys have.
Sure, Eric, that's a great question. And so in terms of risk, we basically look at two primary things. We look at momentum, and we also look at volatility. And we look at the momentum and volatility of various important markets, such as credit spreads. We can look at the equity risk, and we can look at interest rates via bond risk, and we can look at also commodities. And we incorporate the momentum and volatility of these markets as they're needed for each individual asset that we trade. And so we take a look at that, and we convert that momentum and volatility into a probability that a given market will outperform cash. And so if the probability that a given market will outperform cash is high, then we will hold risk exposure to that asset. If the probability is low, then we will hold cash or fixed income in that specific asset class. And so we use this macro risk indicator as a means of governing our offense and defense from a bottom-up perspective, but it affects the overall offense and defense of our entire portfolio for the various funds.
Yeah, I think this whole
exception of XUSA.
Yeah, I think the whole idea of going offense, defense is something a lot of investors can get on board with. Maybe you can tell us how you guys have been looking at the market. Here we are in early June. but maybe you can tell us a little bit about how you guys have been seeing the market in terms of offense versus defense, in terms of allocations so far this year.
I would say so far this year we've tended to have a higher level of offense than defense, although there have been periods, where we've de-risked the portfolio somewhat, but generally modest amounts. It also depends on the fund, and so, for example, in our risk-managed real return fund, QXR tends to hold assets that are more exposed to commodities, have a high correlation to inflation and also commodities. And so commodities have fallen substantially this year. And what we've seen has been a great example of how our risk-managed approach helps us to preserve capital by both, the process underneath the fund is we try to allocate to the best performing markets, and we also try to manage the offense-defense. And so far that was quite successful at managing risk in that particular example.
Do you guys ever use volatility instruments like VXX? And do you ever consider shorting any particular market, or you just primarily go to cash and fixed income when things aren't looking as good?
We currently don't use any of those markets for the primary reason that these funds were designed to be relatively simple and easy to understand with asset classes that are relatively familiar. We believe that those instruments have some nuances that require both a higher degree of understanding on behalf of the investors that are investing in them, and also a higher degree of complexity in how they get managed within the context of the portfolio, but they are valuable. But, in our case, we feel that it's just easiest to manage offense, defense via fixed income and cash.
Yeah, makes a lot of sense. Now, let's switch gears real quick and talk about some of your funds that use this approach. One I wanted to focus on is QXGG, the Risk Managed Growth ETF. Maybe you can tell us a little bit about the focus of this fund, maybe a little bit about what it's comparable to, that sort of thing.
That's a great question. And so the QXGG, the focus of that fund is to provide exposure to global equities. And so it has a capacity to hold domestic, international, and emerging market equities. Tends to have more of a domestic focus, but it does have the capacity of holding fairly decent size in either international or emerging equities. And so as a policy weighting, we tend to have about 60% in domestic equities, 20% in international equities, and 20% in the best performing market of those three. And we also have XUSA as a representation of our domestic equity exposure in order to give us greater upside capture relative to downside capture versus a traditional index fund. And so because we manage risk, it affords us the ability to have, first of all, two layers of risk management, one in terms of the stocks that we choose, and then the other in terms of the offense-defense decision. And it also allows us to get a little bit more juice, so to speak, when the markets are rising, and that's due to the fact that XUSA has the capacity to shift its portfolio beta as a function of market conditions.
Yeah, I wanted to ask a little bit more about that XUSA fund, because right now we're seeing decent assets in both SPY and EFA in your risk-managed growth ETF, but the bulk of the exposure is in this XUSA product. It also targets U.S. stocks, so maybe you could tell us what sets this apart from a fund like SPY, and why do you think this is an important way to get exposure to the market instead of just going with a regular small, mid, or large cap ETF?
That's a great question. I think the first answer is that it tends to be very factor agnostic and highly flexible. It can be in any general market cap range. It draws stocks from 50 stocks, typically from the Russell 1000 index, and it can encompass, on a month-to-month basis, it could be in any particular traditional style or cap range, and also have different factor exposures, whether value or growth. It uses the options market, which is really unique. No one else there is basically doing it. It uses the options market to determine which stocks have the most favorable implied returns, or which is in our case we derive from taking a look at the option implied upside volatility versus downside volatility. And so the stocks it selects tend to have greater upside potential relative to their downside. And also by managing the portfolio beta within that fund, which we do as a function of market conditions, we can potentially also get more upside during favorable market conditions and lower downside risk during bear market conditions, for example. And so, we feel that makes it a superior substitute than just simply holding a static, large cap exposure, simply because sometimes, large is in favor, sometimes mid is in favor, sometimes small cap may be in favor, value, growth. It can span the spectrum. And so this has the capacity to sort of go anywhere. It's somewhat all cap, although it's tilted towards larger caps. And so, we feel that it's a superior substitute.
That makes a lot of sense. Let's also briefly talk about QXTR. That's the Multi-Asset Total Return Fund. What are the potential options for this fund in terms of the various asset classes it can hold? Is it pretty wide-ranging, and are you going to be holding some similar things that you would hold in the QXGG fund?
It's a great question. And so QXTR is what we like to call our Go Anywhere fund. And so it can really, hold concentration in a wide variety of different asset classes, the broad ones being equity, fixed income, and real asset or commodity exposure. And so it does so in order to shift the portfolio to the best performing asset classes for a given macroeconomic environment. And so in some environments, we may see that inflationary assets or real assets tend to be doing well. In some cases, maybe equities. It gives us both diversification, but also some degree of concentration in the better performers. And it can really draw on a wide pool of different asset classes at any one time.
Yeah, I also see both SPY and RSP in the fund. So that's obviously the market cap weighted for SPY and then the equal weight for RSP. I guess I'm curious as to why you'd include both of these in the portfolio.
That's a great question. And what we find is that the RSP or the equal weight as well as the small cap can give you some higher beta exposure and can potentially outperform the market during certain conditions. And so what you typically see, although what we haven't seen it over the last 3 to 4 months, is that when the market is rising, the smaller cap and an equal weight approach tends to outperform. Some exceptions include the late 90s where really large cap stocks tend to outperform. But on average, that tends to give us a little bit of extra beta. And so what we look at within QXTR is, first of all, which asset classes can we expose ourselves to, and where do we want to concentrate? And then, furthermore, which sub-asset classes within those categories, have higher beta or higher capture, assuming that when we look at the macro risk indicator, it's on offense, and that gives us the ability to potentially add some additional value.
Yeah, and another interesting holding I saw in there was PUTW. So it's a put-right fund. Can you discuss the wisdom of including these types of products in the portfolio? And are there a lot of other alternative ones that you can see including in the future?
Yeah, so I think that's a great point, and we hold that one specifically. We also hold it in our multi-asset income fund, and we feel that it's a good diversifier, and because, generally options-related funds tend to be a means of reducing volatility and giving you greater risk-adjusted returns, and over time, generally comparable and potentially higher returns than buy and hold, but most certainly greater risk-adjusted returns. And so it's a good diversifier. We want to have asset classes that perform well in a range of macroeconomic environments, but also in environments where, for example, if the market was to move sideways, these options selling ETFs, they have a tendency to perform quite well in flat or choppy markets. And that's because they will earn the premium by selling their option when the market happens to go nowhere, whereas the index may be flat or slightly negative. And so we feel that it's also another separate asset class and a good diversifier for the portfolio.
And another thing that I noticed was most of your products are fund of funds, but not so for XUSA. And so I guess I was wondering, why exclude XUSA from this fund of fund approach? And then why use the fund of approach at all? Is it just sort of a additional layer of diversification?
I think in a perfect world, I think we would love to manufacture our own exposures. I think as an active manager, you have a tendency to want to add value in as many places as possible. XUSA allows the ability to add value on a bottom-up basis or through security selection, whereas the fund of funds allow us to add value on a top-down basis. And ideally, we would like to be able to add value at both levels. And so QXGG is the one fund that allows us to do it at both levels. And ideally, we would be able to utilize that approach, across the board.
And so why might an investor consider any of the funds that we talked about today? Maybe you can tell us a little bit about how you see them fitting into an average investor's portfolio.
Sure. That's a great question. I think it's worthwhile. It really depends on the investor's mandate or approach. We view these funds as sort of a color palette from which you can customize or enhance your portfolio from various perspectives. So broadly speaking, adding the risk managed funds allows you to lower your risk but increase your exposure to various asset classes. So for example, if you hold more QXGG, you can increase your equity allocation while still having some downside risk protection. And so that allows a person that may have a large percentage of equities in passive equity holdings, which have been very popular lately, placing either a portion or a large amount in QXGG would allow them to gain that global equity exposure with some downside protection, especially if they're concerned at the stage where they're 10 years, prior to retirement or they're in retirement. In terms of XUSA, it's an excellent, core equity holding and can enhance potentially performance and upside versus downside capture relative to traditional holdings. Multi-asset income is a great way to enhance the income of any income-oriented portfolio while also providing that key downside protection. I mean, with interest rates being as low as they are and having the potential to rise, you want to have the capability of rotating into different favorable income-producing asset classes, and you want to be able to protect yourself on the downside because in 2008, a lot of seemingly very low-risk income-producing vehicles fell 40 or 50%. In terms of QXTR, we view that as an alternative substitute. So if you have hedge fund or alternative mutual fund exposure, we think that that's a great place for that. In terms of trying to gain some inflation protection, the ability to diversify some of either your fixed income or equity exposure or both within a traditional 60-40 portfolio, QXRR is a great way, or risk managed real return, is a great way to provide some of that real asset exposure with some of the downside protection, which tends to be critical because real assets can be extremely volatile and have both very large bull but also very large bear markets. And so they're great diversifiers, but you want to be able to have that downside protection.
Definitely.
So in combination, you can use these things to create different investor profiles, as we have for Blue Sky, for our clients, and you can use them to enhance your existing holdings on a per fund basis.
Eric, what I would add to that, this is Keys, is that if you look at a lot of the research that's been done on what the equity returns are going to look like over the next 10 years, or the estimates, right? They're pretty low, right? And the prices are high. We're at the market highs right now, so PE ratios are incredibly high. And so when you look at what forward-looking expectations are for returns, let alone real returns, it's not looking so good. So combine that with we don't have the tailwind in the bond market anymore that we once did with kind of about 2% on the 10-year, and the potential of the interest rates rising. Investors and advisors are looking at how do I build a portfolio that's going to earn anything over the next decade, right? And so where they have to go, in our opinion, is the equity side of things, whether it be international, domestic, emerging, et cetera. So if they need to take an increased exposure to equities than they historically have in order to get a return, in order to accomplish their goal, i.e. retirement, et cetera, they have to increase that equity exposure. So what our risk managed fund suite allows them to do is to take on that additional equity exposure if that's what makes sense for them, but not taking on the additional volatility that may come into it and the additional downside risk. So we want to provide kind of that overlay to the prototypical portfolio and say, we'll give you the global equity, real asset, fixed income kind of exposures, but we're going to give you some coverage on the volatility side and downside so you can actually take more risk in the portfolio with protection on the downside, if that makes sense.
Yeah, and I think that that seems like a decent strategy in today's uncertain market, especially with some of the issues that you highlighted. But I think that's about all the time we have for today. I want to thank you guys for joining me and walking us through a risk-managed investment approach. I think this is a great podcast. Thanks.
Our pleasure. Thanks, Eric.
Thank you. Take care.
All right, everyone. That was Keys Tinney and David Verratti of Blue Sky Asset Management and QuantX Funds. You can learn more about Blue Sky at bsam.com, while QuantXFunds.com has more info about the products we discussed, including XUSA, QXGG, and QXTR. Well, hope you enjoyed this edition of the Duchin Report, and make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts on the ETF world, make sure to go on over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. And don't forget to find and review the Dutram Report on iTunes. And if there are any topics you want us to discuss, feel free to reach out at podcast@zacks.com, my Twitter page @EricDutram, or leave us a comment on Facebook too. And be on the lookout next week for a new edition of the Dutram Report, where we're going to be taking a closer look at the world of the Internet of Things and financial technology. That's next Thursday, so make sure to check back then for this next update. But until that time, for Zacks.com, I'm Eric Dutram.